My name is Dino. It says here in content and SEO. I guess that was in a past life. I currently do I wear several hats: Sentiment, a little bit of business development, a little bit of market analysis. I've been with Sentiment for more than 2 years now. And yeah, today the topic of this discussion, which I really hope is going to be more of a discussion than a presentation. So feel free to raise your hand and ask questions if there is anything that you don't really understand while I talk, because I will be sort of introducing some new concepts and some new metrics and the way that we visualize cryptocurrency behavior. So anything that you feel like I could provide a little bit more clarifications on, just let me know. So the topic of today's presentation is how to use on-chain metrics for cryptocurrency behavior analysis. And let's see if this works. It does not. All right, good.
Maybe try this one.
Okay. Am I doing something wrong? Maybe I can just switch it manually. I mean, this can work. Sorry. Yeah. All right. Oh, right. Sorry. Beautiful. Thank you. Yep. All right. So a few words of introduction about Sentiment for those of you that are not familiar with the project. So Sentiment was established in late 2016. Maxim Balašević, our founder, he essentially back in 2016 thought that the cryptocurrency market and the way that people analyze cryptocurrency market is fairly deficient and defective, mainly because of the fact that back in 2016 and very much so today, 2021, a lot of what people and most sort of cryptocurrency enthusiasts use in order to contextualize cryptocurrency behavior is they use price and volume data. So financial data usually taken from a variety of cryptocurrency exchanges aggregated into a single data. So the great thing about cryptocurrencies is that we now have a wealth and breadth of new data sources, alternative data sources with which we can sort of figure out what's going on with any particular network. We can gauge the health of a cryptocurrency project from a variety of different perspectives that weren't really available in traditional finance, right? So I'm not only talking about data directly from the blockchain, I'm also talking about data from thousands of public GitHub repositories that nearly every cryptocurrency project provides, which can allow us to more easily visualize just how active a project is from a development perspective. And that sometimes points to specific specific ways to analyze the health of a project from a variety of perspectives. So very briefly, the main goal of Sentiment is to use alternative data sources, and we have 3 that we have sort of built our entire platform around, to identify and then clearly track or visualize the behavior of what we believe are key stakeholders for any cryptocurrency. Now, this information can obviously be used for trading, but also it is used, our customers range from quantitative developers and engineers to retail traders, large digital asset management platforms, cryptocurrency exchanges, journalists, anybody really that wants to get a better sense of or better sort of context about everyday market events and the health of a particular network. So for us, we are sort of focusing on several large key stakeholders, anything from the retail sector or the crowd to cryptocurrency developers, the so-called whales or large addresses, which usually have a disproportionate impact on the health and the price performance of a particular cryptocurrency. Exchanges as a major factor today because most cryptocurrencies are still sort of largely speculative in nature. Retail traders, early adopters, as well as long-term holders of a particular cryptocurrencies, team and infrastructure wallets, and currently or more recently liquidity pools, NFTs, and all that sort of beautiful new market narratives that are emerging in 2021. So over the last 3.5 years, we have developed about 100 different metrics, some of them unique, for the first time sort of built exclusively in-house by our team. When you use all of the sort of versions of our different metrics and you compile them together, that comes out to about 800 of them. Obviously, I'm not going to be talking about all of them. Today, we're hopefully going to cover about 5 or 6 of them that I think give a pretty good sense of how we use on-chain data specifically to visualize the behavior of a particular network and then what to do with that information. If we have some time in the end, I will also try to show a little bit about our social data as well, which is still sort of an untapped sector in the cryptocurrency space. And we are one of the first companies or first projects that have, for the last 3 years, been doing a lot of social listening, monitoring about 1,500 different cryptocurrency-related social media channels. And that data we have used to create a bunch of new metrics and indicators that seem to have quite an interesting correlation with a coin's performance over time. All right, so we're going to start with something that's a little bit of a mouthful. So basically, actually, let me go back a little bit. The first, so I mentioned 3 sources of information that the entire Santiment platform was built around. These 3 sources of information are on-chain data, social activity or social media data, and development activity data. So mostly today I'm going to be talking about on-chain data. We collect on-chain data directly from the blockchain nodes. There is no intermediary between the Santiment platform and the blockchain itself. We currently provide on-chain data for about 1,500 different cryptocurrency projects, which to my knowledge, anybody can feel free to correct me if they can find one. We are the most comprehensive platform in terms of on-chain coverage. So our cryptocurrency on-chain coverage includes Bitcoin, Ethereum, all ERC20 coins or coins using the ERC20 standards. In other words, coins that are built on the Ethereum platform, Ripple, Litecoin, EOS, and we are now introducing Polkadot as well as Cardano, which have been sort of very popular by with our community. And we're constantly trying to expand into new blockchains, but obviously, the infrastructure for building and scraping data from every specific blockchain is quite resource intensive. So for now, we are focusing on what we believe will have the most sort of longevity on the market. All right, so I'm going to start with something that we have developed exclusively at Santiment. It's called the mean dollar invested age. And I think although it's a little bit of a mouthful, I'll try to explain it to the best of my abilities, and then feel free to ask me any follow-up questions. But I think it's a good sort of macro indicator to give you a sense of how we use on-chain data to try and visualize what is going on with cryptocurrencies and its network in a very sort of macro way and from a macro perspective. So mean dollar invested age is a metric that we've developed back in 2019. And essentially what we do is we're going to use Bitcoin as an example, but the same sort of patterns work for any cryptocurrency, right? So the way that this metric works is we collect data from the blockchain, and then we try to determine how long each unit of Bitcoin has stayed in their current address. And then we compute the average age of all those Bitcoins. So by age, I mean the amount of time that a particular unit of Bitcoin has stayed in their current address. Let's say I have acquired Bitcoin 30 days ago, so that unit of Bitcoin has an age of 30 days, right? So we do that. We determine how long each unit of Bitcoin has stayed in their current address, in their respective address. We compute the average of all those ages for all units of Bitcoin in existence, and then we adjust it by the price at which each unit of Bitcoin was last transacted on the blockchain. So I know that's a few different sort of relatively complex things, but the end result is very simple, and maybe it's best that I just show it on a chart and show you what we believe it represents. So this purple line is mean dollar invested age for Bitcoin for the showing the last, I think, 7 or 8 years of Bitcoin's life cycle. And then in green, obviously, is the price action of Bitcoin, which has been pretty impressive. So what generally mean dollar invested age does is when you see a rising slope in this metric, overall, as a rule of thumb, that means that the average age of all units of Bitcoin is rising, meaning that units of Bitcoin are becoming older, or in other words, they are not as actively being moved on the blockchain. In other words, most Bitcoin investors, most Bitcoin holders in this part of the cycle are content with sitting on their bags. There's quite a lot of value accrual and value accumulation, not a lot of value redistribution. So this is basically a period where the Network-wide sentiment is mostly tailored to hodling or holding cryptocurrencies rather than moving them between addresses, right? And then when you see these large drop-offs or declines, a declining slope in Bitcoin's mean dollar invested age, this is a period in time where the average age of units of Bitcoin is becoming lower. In other words, Bitcoins are becoming younger, by which I mean simply they're being more actively transacted between addresses, right? And as a result, this portion of Bitcoin's mean dollar invested age chart usually points to periods of redistribution of Bitcoin from stakeholders A and B, whatever they might be, to stakeholders X and Y. So overall, what's interesting with Bitcoin's mean dollar invested age is that, as you can see, several times over Bitcoin's life cycle in terms of its price action, there have been periods of large declines in Bitcoin's mean dollar invested age charts, which have coincided with the sort of start or a mid part of Bitcoin's bull cycle. So the first thing happened the first time it happened was back in 2013, although you can't really see it just because, well, Bitcoin has gone crazy since. The second time it happened was in 2016. The next time it happened was in 2019. And then the last sort of big drop in Bitcoin's mean dollar invested age has happened in 2020. So essentially, like I said, most of these large drop-offs points to a period of time where there is a massive redistribution between addresses. We believe that in 2013, this first drop-off or valley in Bitcoin's mean dollar invested age has pointed to a period of redistribution from sort of early blockchain nerds to first wave of cryptocurrency enthusiasts and early adopters. Back in 2017, this was the first time that cryptocurrencies really saw or sort of have taken center stage. So this points to a period of redistribution from those early adopters to the first wave of mainstream cryptocurrency investors. And then lastly, this large drops in 2020, we think coincides with the general market narrative that in 2020, the institutional investor has taken a huge interest in Bitcoin in particular, but cryptocurrencies in general. And this sort of coincides with this massive redistribution from sort of weaker hands to large institutional addresses. And later on, I will show a few additional metrics that seem to confirm or validate that theory for us. So this is how overall Bitcoin's mean dollar invested age works. And then on the other side of that coin, we also see that several times as Bitcoin's mean dollar invested age sort of hits a bottom and then moves into the opposite direction or starts charting an upward trajectory, it seems to coincide with the period of price depreciation for the price of that coin. So we've seen it back in 2017, back in 2019, as well as back in 2020. So here we think what typically explains this is that the redistribution cycle is over. Most investors are now moving into dormancy, and overall the network-wide sentiment seems to be moving into lethargic, sort of more of a lethargic mood. There's not a whole lot of value being created on the network anymore. There's not a lot of value being transferred on the network anymore. So from a fundamental perspective, there's not a whole lot of fundamental justification for the rally of that coin to continue because value is sort of sitting on the sidelines, right? In general, you can see very similar patterns in Ethereum's mean dollar invested age. What is obviously sort of great, but also a drawback for mean dollar invested age as a metric is that it works best for coins that have a lot of history. So you can sort of clearly visualize market cycles, right? So this isn't going to work for, I don't know if anybody's interested in Shiba Inu or Dogecoin, but it's probably not going to work for those simply because there's just not a whole lot of history for a lot of meme coins as of yet. There will be other metrics, but not this one in particular.
So
all right.
I have a question.
Yes, please.
Is this a lagging indicator or can it be used in real time for an informed decision?
So, one second. So we've written a couple of articles back when Bitcoin's mean dollar invested age sort of started moving. So we sort of measured the divergence of Bitcoin's mean dollar invested age and the price. And we've written, I think, one article around 2019 where we basically said that it seems like the mean dollar invested age is moving into a bearish direction. And, several months have passed that sort of coincided with this conclusion of ours. So, in our opinion, this isn't necessarily a lagging indicator, but can be used in real time. We haven't done a sort of created a strategy or a backtest of this particular metric. We have done it for several others. But yeah, there are people in our sort of institutional, some of our institutional customers that use this metric particularly to rebalance their Bitcoin portfolios. Yeah.
I have a question.
Of course.
Also about Bitcoin is obviously a great source of store of value, and it's not really a currency that has a lot of utility.
Yes.
Besides that, what is a chart what this will look like for Ethereum or even like BNB, where you can use for different kinds of DeFi NFTs? There's a lot of movement.
Great question. Even though in general it seems like I would love to share it live, the chart for Ethereum, maybe after the presentation I can show you. But in general, it actually seems to follow fairly similar patterns. So even for coins that have not just a speculative purpose, but a lot of sort of utilitarian use cases, I think that's mostly currently Ethereum and a few other coins, but most of them are still fairly speculative in nature. It seems to follow the same patterns where they're sort of the utility line is sort of the same or rises, but there's still periods where on average on a network level, holders are moving into a more dormant period or dormant sentiment, and then there's a period where both holders are redistributing, speculators are more active, as well as the utility of the network is rising. So it sort of accounts for it in both ways. It's a fairly similar chart overall.
I'm curious to see it.
Yeah. I'll be happy to sort of share it after that.
Do your other matrices, whatever the word is, do they account for some extent as to what's causing these fluctuations? Because that's very straightforward. It's straightforward enough to see that. But then, do you take into account sort of macro political circumstances, regulatory circumstances? How can we relate what you're showing us there to what the influencing factors are?
Of course. So that's a great question. We try to sort of conflate or juxtapose these metrics to a bunch of different metrics that try to explain different parts of the cryptocurrency behavior. So for instance, what I'm going to show in a little bit is that this sort of period or massive drop-off in Bitcoin's mean dollar invested age has coincided with a period of fairly large accumulation by addresses holding between 100 and 10,000 Bitcoin. So that sort of large Bitcoin millionaire segment of the Bitcoin audience. So there, obviously, when it comes to on-chain data, there are inherently some assumptions to be made. We can't account for every single transaction and know its full intent. But the best we can do is that we can use additional metrics, specifically from the blockchain, to account for what is the most likely reason that we are seeing massive drop-offs or massive inflows. So, for instance, like I said, massive accumulation by large addresses has coincided with this period, as well as generally very large growth in the total addresses that are interacting with Bitcoin on a daily basis, which has sort of flattened out for much of 2019 and then has started peaking back in 2020, suggesting that there's sort of a new rejuvenated interest in Bitcoin as a network on the whole. So I have a few of those metrics that I'll be happy to share as we go along. Any questions more on Bitcoin's mean dollar invested age? I hope that, how much time do we have? I usually lose track of it. Yeah, it's been 20 minutes. All right. So we might want to go into a few more of those, and then you can feel free to.
What is this telling us about the future?
Yeah, great question. I'm not sure. So generally speaking, what this seems to be telling us, at least at this point in time, is that there has been a general paradigm shift in terms of Bitcoin's holders once again towards dormancy. Now, this has changed a little bit over the last maybe week or so, and this I have a few other metrics that sort of seem to explain why. But overall, from a fundamental perspective, we are not a big fan of periods of time where money is standing on the sidelines and not a lot of value is being transacted on the network. Specifically for Bitcoin, but also Ethereum and other coins, we think that periods of dormancy on the network and periods of low value transfer typically coincide with a sort of less of a push or less of a potential for massive sustained price rallies. So I'm not surprised. I don't think Bitcoin can go up and down, but from a sort of macro perspective, if this sort of chart continues to trend in the upward trajectory, I would sort of be a little bit concerned for a couple of years for Bitcoin's price action. Obviously, it's all cyclical, but it does seem to point to a period of concern for some Bitcoin holders. Not investment advice, obviously. Yeah. So the next metric that I want to talk about is probably the most popular on-chain metric right now. It's called the MVRV ratio. I'll show what it looks like here before we go into explanations. It has been created back in 2018 by Nick Carter, and like in very layman terms, what MVRV ratio does or tries to do is it tries to compute the average profit or the average loss of a group of addresses of all addresses that have acquired tokens within a certain time frame. So I can explain how that works as a simple formula. So MVRV ratio stands for market value to realized value ratio. So it's a fairly simple formula where you just divide two parameters. So you take the market valuation or market cap of a coin, which is simply total supply of a coin times the current price of that coin. That's how you get the market cap of a coin. And then you divide it by the realized value of a coin. So realized value takes the total supply, current supply of the coin, but it multiplies it by the price at which each unit of that coin was last transacted on the blockchain, which the assumption was the time at which they were acquired. So it's basically the difference between the total amount of money that would currently take to buy, let's say, all of Bitcoin versus the total amount of money that was taken to purchase all Bitcoin in existence, right? So as a result, we get this sort of ratio. And for example, when I made this chart, Bitcoin was still sort of at a 65K range, and it was at the 30-day MVRV ratio was at 18.12%. So what that points to, the 30-day MVRV ratio essentially points to the average profit or the average loss of all addresses that have acquired Bitcoin in the previous 30-day span. So it's basically looking at the average profits of short-term Bitcoin holders. At 18.12%, that means that the average profit of the swing traders or short-term Bitcoin holders was plus 18%. They were plus 18% on their initial investment on average, right? So what does this tell us? Or how do people generally use this metric, right? Let's move back a bit. So the way that on-chain analysts use this usually is that they believe that because as MVRV ratio rises, that means that there are more unrealized profits sitting on the sidelines by a specific category of coin holders. So as MVRV ratio rises, the higher the MVRV, the more unrealized or unclaimed profits there are. And as a result, the more likely it is that holders are going to start claiming those profits at some point in time and applying massive sell-side pressure. So in general, the higher the MVRV ratio, the more overvalued and potentially risky a coin is. And then the lower the MVRV ratio is on the other side of the aisle, the more undervalued or the more open to time it can be to accumulate, once again, not financial advice. So with that sort of context, what on-chain analysts then do is then they use a bunch of data, historical data, and they look at historical peaks and valleys. And we have done some backtests on this that I'll show in a moment, where they essentially look at periods in time where Bitcoins or a coin's MVRV ratio tends to peak, both in the upward direction or a lower direction. So what are the peaks and valleys of a specific MVRV ratio to look for historical trends or historical danger and opportunity zones for a particular coin? So for 30-day MVRV ratio, what we see is that there is a tendency, or there has been a tendency for Bitcoin's MVRV ratio over the last 3 to 4 years to peak between 15 and 20%. There are several short-term outliers, but even those last for no longer than several days and generally points to an overvalued territory or sort of unsustainable price rise, right? So between 15 and 20% seems to be the average sort of dangers for Bitcoin short-term holders, or that seems to be a period in time or sort of profit margins at which short-term Bitcoin holders seem to like to take some profits off the table, between 15 and 20%. And then on the other side of the aisle, around minus 15% all the way to another support level at minus 30%. These seem to be two levels at which Bitcoin's 30-day MVRV ratio seems to historically bottom out and points to a potential for upward price recovery. Now, we have done some backwards. Oh, right. Let me show this one as well. So this is the 365-day MVRV ratio, which is showing the average profit or average loss of all addresses that have acquired Bitcoin in the previous 365 days. So it's sort of a longer-term view or gauge of investor sentiment. And overall, I think we're showing here 2017. There was one even larger, I believe, in 2014. So the MVRV ratio, especially the long-term MVRV ratio, has shown a tendency to sort of flatten out over time, which seems to point to a general maturation of the cryptocurrency speculation. So with every subsequent market cycle, it seems like the highest level of MVRV ratio, or the highest profit margins, or the levels at which both long and short-term holders like to sell, seems to flatten out a little bit, pointing to more of a risk-on behavior with every subsequent market cycle, as people seem to no longer expect outsized returns like they did in 2017, but are completely fine with taking or starting to take profits at relatively lower levels. We're still talking about 200 or 300x, right, from their initial investment. So this is a backtest that we've done, I believe, about 12 months ago, where we wanted to see if there is a possibility to create a real-time model where you would use an MVRV ratio to determine when to sort of enter into a trade and exit out of a trade, right? So what we have done is we have taken the entire history of Bitcoin and we have split it into 30-day chunks. And in each of those 30-day chunks, we have looked at historical local peaks, that is, and local bottoms for a particular MVRV ratio. Here we're looking at a 30-day MVRV ratio. So for each 30-day chunk, we look at the local extrema or local maxima, local minima, and then we compute the median values of all of those local peaks and bottoms, and we get two values. We get the median peak and median bottom for an MVRV ratio. And then we use those two values as signals to buy and to sell, or actually to sell and to buy. So when Bitcoin's MVRV ratio hits this predetermined threshold based on historical data, if it hits a peak MVRV threshold, we sell. And then if it hits a bottom MVRV threshold, we would buy, simply using on-chain or sort of crypto-native metrics. So these were our first attempts at trying to visualize this. As you can see, there are several interesting positions where our model was able to sort of recognize that the market is becoming a little bit overvalued for its own good, and on the other hand, periods where the market seems to be sort of overselling and looks a little bit too frightened for its own good, right? That being said, obviously it's not a perfect indicator. For example, we would trigger a signal here, even though there would be another sort of more or better or more opportune time to accumulate. So we're still tinkering with the thresholds, with what would make the best possible real-time trading strategy, but we've actually created an index that is based specifically on this metric, where you can rebalance your portfolio of as many coins as you like by looking at a 30-day MVRV ratio and rebalancing when the things become too heated or things become sort of too undervalued. I think I have another example. This is for Ethereum. So same idea, looking at the 30-day MVRV ratio, these would be the times that our real-time signals have triggered, and then these would be the times where our real-time buy signals have triggered as well. So a few interesting sort of ways to visualize cryptocurrency network behavior, and also maybe create models to try and get advantage in the cryptocurrency trading space, specifically using crypto-native metrics or the behavior of the actual network. So any questions on this before we move forward? Yes?
Is this ratio calculated based on the weighted average?
Sorry?
Is this ratio calculated based on weighted average?
No, this actually, it's not. It's the not the weighted average. It's just the standard average. We don't. There is a metric that uses a weighted average. It's called the MVRV ratio. But we've so far had better success with just using the normal average for these for the backtests that we've done. All right, now we're actually going to get into, it's a weird way that I've made this presentation, because we're getting now into something a bit more simple. So maybe I should have started with this. This is what we like to call price DAA divergence. So DAA stands for daily active addresses. And I think most people here know what daily active addresses sort of represents. It's one of the most basic metrics that you can use in figuring out the performance of the behavior of a network. Daily active addresses simply stands for the total amount of unique addresses that are involved in transactions or that are interacting with a coin on a daily basis. By interacting with a coin, I simply mean buying or selling a particular cryptocurrency on a daily basis, or just moving it on the blockchain. So based on both backtests that we have done and just anecdotal evidence, it seems like sustained price rallies typically go hand in hand with periods of large growth or sustained growth in daily active addresses, which a lot of people, on-chain analysts, use sort of as an on-chain proxy for the amount of demand in a coin, right? As daily active addresses rise, it seems to point to another sort of wave of fresh blood, as well as another period of value accrual and value redistribution within a network. So that sort of makes sense that from a fundamental perspective, you would like to see price growth coincide with growth in terms of just the network effect of a particular coin, right? Now, what's interesting there is that we have then tried to, we have seen sort of the opposite trend as well. So we have seen periods where a coin's, let's say Bitcoin, Bitcoin's price action continues to rise. However, the price, daily active addresses, or let's say network activity or address activity, starts to flatten out or decline. So in that point of time, we are seeing a sort of divergence between the price or market valuation of a coin, while the total value transfer and the total network activity on the coin is declining. And for us, that seems to generally point to a bearish divergence and a potential for local correction as the market seems to be a little bit overvalued. And then the other thing also applies, or sort of the vice versa also applies. When you see periods of price depreciation for a coin, but sustained uptick in its daily active addresses and on-chain activity, that also seems to point to a bullish divergence where the network seems a little bit undervalued relative to the amount of activity and the amount of network effect it is currently accruing for itself. So we have then backtested this a couple of years ago. I have a chart that shows what's happened since. We backtested this idea a couple of years ago this is the chart that I want to show, where we basically done a similar thing with the MVRV ratio. So we looked at a difference between a coin's price action on the one hand and the coin's network activity on the other hand. So if there's a massive uptick in a particular coin's price action, but there's a considerable downside or sort of a lethargic network activity, that sort of bearish divergence would trigger a sell signal in real time. And then if the price of a coin is declining, but its network activity seems to be on a sustainable growth, that would point or sort of trigger a buy signal. So these would be some of the signals, the first sort of attempt of a price divergence model, where we would sort of sell at these levels and then we would buy back into a coin at these orange levels. So several times that we were able to sort of see, especially back in 2018, just how sort of overvalued the network all of a sudden become. Even though the price was rising like crazy, the network activity seems to have largely been unable to sort of keep afloat or sort of keep up with the price. This is what this divergence model looks like on our platform. So we have all of these charts are live currently on Santiment's website, and you can just log in and see all of them for yourself. I'll share the link at the end of the video. So this is this model applied in real time on our Bitcoin's price action. So these large drop-offs would be periods where relative to its price action, Bitcoin's network activity has declined quite heavily, and then these green periods or green bars would be periods where relative to its price action, Bitcoin's network activity or address activity has started to really blossom. This was in 2017. This was in 2019. As you can see, we have been able to catch several sort of local tops as well as local bottoms for BTC. However, this is what's happened in 2021. So it seems like we need to adjust our thresholds again, because where exactly do you sell here? Do you sell here? Do you sell here? What do you do? Do you buy here or do you buy here? So even though there seems to be definitely value in the idea of a divergence between a coin's price and coins in the daily active addresses, it seems like over time the threshold for defining when a potential signal, buy signal or sell signal should trigger needs to be adjusted. So this is what, I thought I had it for Ethereum as well. Never mind, we can show it on the chart later. So this is what this sort of divergence looks like. And we have a similar metric that sort of works in the same way, called the NVT ratio. And I promise this is the last metric that I'll show. I know usually after 4 or 5, people just sort of zoom out. Or zoom out. I've been there, so I know. Almost there. So this last metric that I wanted to show is sort of takes the same idea, where it compares a market valuation of a coin versus the network activity of a coin. Except here, the NVT ratio, it's an on-chain surrogate for what in traditional finance is, used to know or is known as the price to earnings ratio, where you take the market value per share and then you divide it by the earnings per share to sort of see whether a stock is overvalued or undervalued. The problem with that and applying it to cryptocurrencies is that Bitcoin doesn't have a balance sheet, so you can't really track its earnings, right? So what do? Well, a few inventive individuals have tried solving this problem by using on-chain data and on-chain activity to account for the lack of transparent balance sheets for a particular coin. So what we do with the NVT ratio is we divide a coin's market valuation by the total amount of unique tokens moving on the blockchain daily. So what that sort of tries to do is it tries to compare the total market cap or market value of a coin to the daily value transfer of that coin, which we are using here as a surrogate for earnings, right? And so when the NVT ratio is high, it suggests that a coin's market valuation is too high relative to the amount of value being created on the network daily. And then when it's too low, it means that it could be potentially undervalued because market valuation is fairly substandard or subprime relative to the amount of unique coins moving or being in circulation on a daily basis on the network. So this is what our NVT ratio model looks like. And so currently, at least, we are having some signs of health in Bitcoin's price action and on-chain metrics. But yeah, this sort of points to, this is something that we've done using several weighted moving averages, where we've tried to sort of show periods in time where Bitcoin's price action is too high relative to its token circulation or general amount of daily value transfer on the network, and when it's too low. So when these red bars point to extremely high market valuation relative to network activity, and then these low bars point to relatively or extremely low market valuation relative to the amount of value that is being created and transferred or redistributed on the network on a daily basis. So we were at the very least able to sort of, the first time our NVT ratio has started going green was back in October of 2020, which also coincides with that. Let me move to a bunch. Okay, it's too slow. I wanted to show the mean dollar invested age chart once again, because you will see sort of a period, the mean dollar invested age chart started to drop off exactly here. So at the point in time where there was all of a sudden a massive amount of new units of Bitcoin being daily transacted on the blockchain, this is the point in time where we saw Bitcoin's mean dollar invested age start to drop as well. And then in March of 2021, from a fundamental perspective, this was a period of time where Bitcoin started first exhibiting some concerning signs or concerning patterns where when it hit all-time high, or relatively, I think even about a month earlier before it hit all-time high, its price action was no longer sustainable, at least from a fundamental perspective. So based on the total amount of value accrual and value creation on the network, its price action was no longer fundamentally justifiable. And so far, it seems to have been on point. So like I said, this only takes into account this last green ticker, only takes into account about a 7-day stretch, so keep it with a grain of salt. But generally speaking, what we like to see is we like to see periods of increased growth in terms of on-chain network activity. And that means both in terms of the amount of daily addresses that are interacting with the coin, as well as the amount of unique coins that are moving on the network.
Can I ask a question?
Yes.
It looks like if I had just simply sold when I see the first non-green candle and bought when I see the first green candle again, I wouldn't have done too bad. Like in the very back of the napkin approach to this.
Here?
So thereby, I sell where there's the first red, I buy again where there's the first green.
Yes.
I sell it and continue this.
Yes.
I'd be doing really, really well.
You would be doing okay. We actually haven't done a real-time model on this one. like we've done with MVRV ratio and price DA divergence. But this is a fairly popular model in on-chain circles. We're not the only company that has it. We are the only people or sort of company that has created this model, which uses, I think, 4 different moving averages for NVT ratio, rather than just a total difference between market valuation and token circulation. But you would do okay-ish with this chart or this metric. So generally speaking, the whole point of this exercise of this presentation is showing several ways that we only look at potential investment opportunities or do due diligence on a project based on crypto native metrics, nothing else, no sort of price and volume related data, order book data. So obviously, I think that's a relatively limited approach. We're not against using technical analysis and price and volume data, but we believe there's just a lot more that is currently still being sort of unused or underutilized in terms of potential metrics to try and beat the market, which is what everyone wants in crypto. If you're interested, I will show you later on the reasons why I sold my BTC at 65K, 3 or 4 indicators that have sort of started flashing on our platform that made me want to, at least for a while, get out of BTC and then maybe get into it at a later date. So, yeah, feel free to ping me.
There is a subsequent question to your thing. Like, do you have any kind of an ensemble decision making where you take into account multiple these indicators and do they perform better than each individual? Did you go into that?
We have not created a comprehensive.
Sorry. Repeat his question.
So the question is, do we have sort of an ensemble, basically a bundle of metrics where we just kind of put it into an algorithm and then it says buy or sell, right? Yeah. We haven't, no. And in general, what we like to do is we like to take sort of or juxtapose or compare all of these metrics individually rather than, we were not able to create a simple algorithm to use all of them into a sort of a uniform way. Generally speaking, the way that we and our community and our users use this metric is they look at them on a daily basis. It takes a bit of time. It's not a very automated process, but yeah, usually I like to look between like 7 to 10 metrics on a daily basis to get a general sense of what the current network activity is like. But yeah, if you could create a sort of an umbrella model, we have tried a few of them. They've performed okay-ish at times, but nothing that would like massively beat the market based on all of the metrics in our repertoire. Okay, so I have.
Quick question.
Yes.
Did your very clever ability to hit 65 to bring you out?
Yes.
Which is what I said. Did that also allow you to come back in for this last 30 days and or? Yeah. So sensitive enough to achieve that.
So not at the moment. I mean, I'm still sort of out of Bitcoin, if that's your question right now. Yeah. But I've also been traveling a lot, so I don't know which one is the culprit for it. But yeah, I mean, the Bitcoin only hit 65K, like a week ago, maybe 10 days ago. So that's when I.
Oh, I see. Okay.
Yeah, that's when. No, the previous one, no, this new all-time high. Yeah, it's not always that I sell the tops, but when I do, I like to brag about it. So yeah. All right. So the last point that I wanted to bring up, I guess we'll have no time for social metrics, which are super interesting. So if anybody's interested in more information about non-on-chain sources and how to use them to figure out what is going on with the markets, please ping me after the presentation. The last sort of metric that I wanted to talk about is the behavior of large addresses. And I only have one example here, but there's more in the document that I've prepared for the presentation. So generally speaking, we are of the opinion that large network addresses still have a rather disproportionate impact on the price performance and the general market performance of the coin. There was an article that was on front page of Reddit yesterday, I believe, which said that Bitcoin is largely headed by a minority of large addresses and sort of concerted interest groups rather than sort of a very decentralized and distributed coin. So based on a recent report that was done by Chainalysis, there was a massive amount, more than 60% of DeFi transactions, so all decentralized transactions in the first and second quarter of 2021 have come from these large addresses and addresses that hold more than 10 million, and actually transactions that are worth more than 10 million. So it's still very much, cryptocurrencies today are still very much a whale's game. So it then makes sense that we would need to look into the behavior of these whales and addresses to figure out what they're doing and whether there are any patterns that we can spot. Now, this is a very difficult thing to do. It's not as easy as it might seem. So this is sort of a most basic way that we do it on the Santiment platform. What are we seeing here? So this current chart shows the total holdings of addresses that are holding between 100 and 10,000 Bitcoin. So quite a stretch, but these are all sort of millionaire addresses, versus the price of a coin of Bitcoin over the last, what is it, like a year of data. So generally speaking, we have seen back in the August and September of 2020, we have seen sort of the first signs of large accumulation by these massive addresses. So anybody that owns at least 100 Bitcoin or more started to sort of accumulate more BTC. This was about 250,000 Bitcoin being accumulated by these addresses in a span of about 2.5 months. So a massive amount of new BTC being scooped up, not by retail holders, but by these large, possibly institutional addresses. And then here, even though we can't really maybe see it super clearly, there have been periods where there's sort of a short-term offloading event. So periods in time where there is a decline in the total holdings of these addresses. This was about 60,000 BTC as well here around the all-time high. Here about 40,000 Bitcoin. So sort of short-term potential profit-taking activities by these large addresses. And then over time, as Bitcoin started to correct, there has been a sort of sign of lack of confidence by these large addresses. Since then, however, we have seen another sort of accumulation effort by these addresses, particularly over the last month and a half. So we tend to use this metric as sort of a very general gauge of whale sentiment. Now, there are obviously several caveats here. First of all, not all addresses that are large are whales. Specifically, there are a lot of massive addresses that belong to cryptocurrency exchanges, right? So if you are just accounting for all addresses, there is a possibility that you are also taking into account like Binance wallets, Kraken wallets, Coinbase wallets. And then if you're seeing a accumulation in those wallets, it's a very different context than if you're seeing an accumulation in whale addresses, right? If I or somebody as a just individual large address accumulates a bunch of Bitcoin, that's a potential bullish signal. But if there's a lot of Bitcoin being moved to Coinbase, that could be a signal that there's a rise in sell-side pressure, right? So this is why usually we don't like to look at any addresses worth more than 10,000 or holding more than 10,000 BTC because there's only about 100 of them and they're mostly large cryptocurrency exchange wallets. And the second thing, and this is what Santiment is sort of working on very hardly, or if that's even a word, in the last 6 months or so, is we're working on improving our labels. So this is where it's no longer enough to just scrape data directly from the blockchain and call it a day. For us, and for as like with every subsequent market cycle, there are additional complexities that you have to account for when it comes to understanding on-chain data. To really understand what whales are doing, you need to properly label hundreds and thousands of wallets. You need to go through each of those wallets individually, and you look for patterns or heuristics that will tell you how likely it is that if this wallet is already not labeled as an exchange wallet, how likely it is that it behaves as an exchange wallet. So there is a level of assumptions that you need to make when doing this type of analysis. But generally speaking, this is what we are, the Santiment team is sort of working on and putting a lot of resources and effort over the last 6 months. And this is what we think is not necessarily the holy grail, but generally what is going to sort of distinguish us from most market competitors is having the best labels on the market so that you can contextualize the behavior of every specific stakeholder and know exactly like whether these specific groups, that you can filter these specific groups of addresses by labels. So for example, show me all of the addresses that hold between 100 and 10,000 Bitcoin, but then filter only those that belong to individual whales, filter those that belong to cryptocurrency exchanges, filter those that belong to yield aggregators, farms, and so forth. So we already have a prototype for this metric. It's on our platform. I'll be happy to show it to you after the presentation. So these were 5 different metrics. So mean dollar invested age, MVRB ratio, price DAA divergence, NVT ratio, and the whales. Like I said, we currently have around 100 different metrics on our website. I'm not going to pretend that all of them are equally effective. They're not. And not all of them are going to tell you what's going to happen with the market or what's going to happen with the market in the next week. There are some indicators that we believe are super valuable, even though they have nothing to do necessarily with short-term market volatility. For example, we are very proud with the development activity metrics that we've created, where essentially we take data from thousands of public GitHub repositories from cryptocurrency projects, and we filter or sort of clean that data where we filter out any non-development related events in the project's GitHub repositories to show what is the level of investment that cryptocurrency projects are putting into their project on a daily, weekly, monthly, yearly basis. How much are they investing in coding manpower in particular, because at the end of the day, developers are probably the most valuable assets in cryptocurrency projects. Is that investment growing over time? Is it dependent on a coin's price action, or is it completely sort of independent of it? And for us, the best projects on a very long-term scale are projects that show sustained growth in development activity, regardless of market cycles, regardless of price action. Teams that are not really looking at the market at all, but rather just continuing to push code and continuing to build. So that sort of metric won't help you to determine what happens with Bitcoin or Ethereum tomorrow, but it can help you understand from a more sort of due diligence perspective whether the project that you might be interested in investing in is sound and whether the team is sound. So I'm going to skip over all of the social metrics. Very sad, yes. I'll be happy to share this presentation with anyone that's interested. This is sort of the end because I think we're already about 55 minutes in. If you're interested in this type of data, several things that you can do. First of all, check out our website. app.santiment.net is our token intelligence platform. So everything that you've seen right now or in the last hour for Bitcoin in particular, we have this data, not just for BTC, but for Ethereum, all ERC20 coins, and a variety of other blockchains that we're currently integrating. Even if we don't have on-chain data for a specific coin, we still have several unique sources of information like social activity data and development activity data that you can gauge on our platform. You can also tap in if you're interested, if you're a quant or somebody that has a knowledge of backtesting and creating your own trading models, you can tap into our API, use all of this beautiful raw data to create your own dashboards, models, and try to beat the market. That's it for me. I hope you found this useful, although I'm sure that a lot of it was, especially after the first three metrics, maybe went over your head. I'll be more than happy to stay here, or you can find me at the booth later so we can talk more. And if you're interested in a few indicators that I use to sort of sell BTC at the 65K, you can come here after.
That was going to be my question. Which metrics do you look at it? Do you look at personally?
So
you would advise your family and friends?
So I never advise my family and friends just because I'm super risk averse. So I just would feel at the end of the day, I can be fairly confident that Bitcoin might grow based on a bunch of fundamental indicators, but it's never 100%. So I would feel terrible if they made an investment choice based on my behavior. But generally speaking, the several metrics that I've used. First of all, I've used the 30-day MVRV ratio that I've shown here. So we do these weekly market streams on every Friday on our YouTube channel. So if you're interested, 4 p.m. Central Eastern Time, actually in a couple of hours without me this time, but usually I'm there as well. We just talk about the market. And 2 weeks ago, or about a week ago actually, we talked about how Bitcoin's 30-day MVRV ratio, which is sort of that level at which short-term Bitcoin holders like to take profits, is starting to reach that historical proverbial danger zone between 15 and 20%. So once it hit about 18%, it was fairly after, sort of a couple of hours after it reached all-time high. That was the first sign of concern for me. Generally, like I showed at the chart, there are several times in the past that Bitcoin's MVRV ratio was able to even get to 40%, but it never lasts for a couple of days. And I'm not one to sort of only sell at the top. So I'm fine with just when there's a red signal, I'll be fine with the profits that I take. So that was one. The other metric that I've used is the sentiment or sort of social data that we have. So like I said, we currently track about 1,500 different cryptocurrency-related social media channels. This includes Telegram groups, crypto subreddits, Discord channels, Twitter accounts, professional trader chats, and we're expanding that list every day. We're now adding different NFT channels, different DeFi and yield aggregator channels. So what we're trying to do is we're really trying to anywhere that the main topic of discussions are cryptocurrencies, we try to listen in. And so over the last 3 years, we've built a massive database. We still collect about 100,000 new daily messages on every day. And we've built a bunch of indicators using that data. So one indicator in particular, sort of social volume, shows dimensions of a cryptocurrency from all of these different sources. And we've done some backtests on this idea that when you see massive spikes in social volume as well as social sentiment of a project, especially if that coincides with the, okay, actually, let me just show a chart. So, yeah, so this is social volume. This is dimensions of a coin plotted against the price of that coin. So generally speaking, we see very often these, obviously it's not always going to look as pretty as here, but we see periods where there's a massive uptick in a social mentions or chatter towards a particular coin. When it coincides with a massive price appreciation of that coin, what that usually indicates is the fact that the market is becoming a little bit, and especially the retail sector is becoming a little bit too overzealous and too greedy for its own good. So these new mentions, they're not people talking about Matic from a fundamental perspective and talking about how great the project is and how much it's going to change the world. It's just a bunch of people spamming rocket emojis and fire emojis, and right. So usually it's the sort of retail crowd becoming hyper aware of the rally, and as a result, that usually tends to coincide. Our founder always thinks that you should bet against the crowd. So anything that the crowd is doing, you should go the opposite way. And this is a metric that seems to follow that pattern to a T. It also points, these massive spikes in social volume points to a period in time where everybody is aware of the rally. So there's also going to be less of a buy-side pressure moving forward, which is going to sort of potentially negatively impact the price of a coin. So I've used so this is a backtest that we've done. So we have this list on the website called Social Trends. It's very simple. It's a list of 10 words that is getting updated every hour, which shows the top 10 words that are gaining the most social volume, or sort of the most mentions of crypto social media, relative to their previous 2-week average. So we're trying to figure out, at this point in time, what are people talking about the most in cryptocurrencies, right? So very early on, when we created this list, what we noticed is when a coin's name or a ticker ends up in the top 3 positions on this list, it's usually bad news for the coin. So what we've done is we've done a backtest where we looked at about 650 different times or events where a coin's name or a ticker has ended up on this list of ours, and the average price performance of these coins 20 days before and 20 days later. So 20 days before, especially 6 days before, you can see the massive price appreciation of these coins on average, which makes perfect sense because the reason they're appearing on our list in the first place is because everybody's talking about them. However, afterwards, there's typically a period of downtrend for the coin. So about 13% on average seems to be a price depreciation in the coins that we have examined. So this was done about 7 months ago, so it was before this final bull cycle, so some things might have changed, take it with a grain of salt. But yeah, this is how we use this data. And then lastly, with our social metrics, we've also gone a step further, and we've used machine learning to not only show you the amount of mentions of a particular coin, but also try to figure out what is the mood of those mentions. In other words, is the spike in mentions of Bitcoin, is that people being very bullish about BTC, or is it people being very scared about BTC? And we here employ the same idea where extremely bullish sentiment we typically think is pretty bad for a coin. And then generally speaking, when a coin is super bearish or people are super bearish about the coin, this is where we like to be from a investment perspective. Like, for example, you can see here this massive spike in Bitcoin's sentiment in particular. Right here as the correction started. This was the time that Tesla announced that they will no longer accept Bitcoin as payment. And a lot of people were happy about it because it allowed them to buy the dip and move into Bitcoin at a discount. So generally speaking, seeing that type of massive spike in social sentiment told us, and there was also a massive spike in buy the dip mentions on our platform. So we thought that this points to a period of time where people are still fairly or sort of too euphoric or too excited for their own good, and it might not be the end of a correction, which eventually it wasn't until we moved into a predominantly bearish atmosphere that Bitcoin was able to start recovering. And so this is Bitcoin at around 59K. When it got to 65K, we basically sort of rivaled these levels. So it was another indicator for me that it might not happen immediately, but it's going to happen probably fairly soon, that we're going to see short-term price depreciation. Short-term is the operating word. I don't think this works sort of on a longer-term scale. Go ahead.
I'm so sorry. It's the end. You could go on for hours.
I'm sorry.
Very,
I could.
very,
Yes.
very, very interesting topic. But thank you so much.
Just ping me here.